Hello, everyone. Welcome to the For Investors podcast, where Wall Street meets Main Street. I'm Andrew Gay, along with Gilbert Pies and Zachary Green, and we are the Texas Hill Country Advisors, based in the beautiful Texas Hill Country here in Kerrville, Texas. And we come to you today to talk a little bit about our latest thinking and perspective on the markets and maybe what has got investors' attention currently. So I think we're going to try to hit a couple, maybe 3 points today: volatility, interest rate expectations, and maybe what it means to be a saver in today's environment. So Gilbert, you want to do the honors there and kick us off with a little bit of commentary on some of that?
Absolutely. Let's start with the first topic, but I also want to acknowledge the fact that it's been a minute since we've done a podcast.
It has.
Not because we wanted to be off, but because we've been going through some changes in our broker-dealer, and it just took us a while. We were so busy trying to get things straightened out that it's been a minute or two since we've had a podcast, but we hope to get back into the groove of things now that we've got all of our issues figured out. And so I'm looking forward to starting a new chapter in our brokerage business, partnering with LPL as our new broker-dealer. So I'm excited. So let's start with the first topic, which was, refresh my memory.
Volatility, yes. Interest rate expectations, or being a saver.
Yes. Well, let's talk about volatility first, because if you go back to our last podcast, which was sometime in early July to now, and where we're at, we're almost going into the last week of August. There's been a lot of volatility the past few weeks. Actually, the market did pretty doggone well the first 2 or 3 weeks that we were off the air, and then the last 2 weeks have been pretty flattish. And then today, of course, we had a huge run up in the market. We had some, Jay Powell gave a speech today at Jackson Hole, Wyoming, an annual conference of the biggest thinkers in finance. And his basic premise of his conversation was that there's been a change in the dynamics in the economy, and the market interpreted that as a rate cut coming soon. And if you don't follow the market very much, or don't really pay attention to all the things that are out there, there's been a big push and pull the past few months about whether or not the Fed is going to cut interest rates, whether they should cut interest rates, whether they should leave them the same. And we've talked on here many, many times about what the reasoning is behind a potential rate cut. Is it jobs, or is it inflation? And if you look at inflation's slowly been creeping up the past few months. It's definitely not back at the Fed's 2% preferred target, but unemployment really hasn't done a whole lot. So my personal thinking is that the Feds don't have much of a reason to cut interest rates just yet. But if you look at the market's interpretation of events today, the market would tell you otherwise, that definitely the Feds are going to cut rates in September. I don't buy it personally just yet, but who knows? The volatility is, I think, tied in directly to the Fed's decisions about interest rates, whether they go up or down. We certainly don't think they're going to raise them, but in a scenario where inflation just continues to tick up, I wouldn't say that even a rate hike is off the table.
Sure.
That's probably the worst case third scenario, but I think the chances of them raising rates is not zero. But it might be a small chance, but you're still saying there's a chance. And I would say yes. So volatility, I would expect, would continue over the next few weeks. The next Fed meeting is the end of September, if I remember correctly. So, between now and mid-September, we're going to have some volatility.
Yeah, September 17th, but we'll get inflation data before that.
Sure, CPI and PCE. PCE will come at the end of August. CPI will be out for August and September. So we will have some more data. And I venture to guess, if I had to put, making a decision today, I venture to guess that PCE and CPI will have increased from their previous readings.
Well, that's a weird. So you think the overall price level will have increased? Because that's like a unless, I mean, because at the price level, the basket of goods doesn't increase, then we have a negative PCE or a negative inflation number on the month. And that hasn't happened too much. It has happened in the last several months. But so the price level rising is probably bound to happen unless we get a negative number. But you're saying that you think the annualized inflation number will be higher than last month's?
Yes.
Okay. All right. Gilbert coming in strong with some.
I'll take a blood oath too. I'll even cut my hand and, shake on it if you want to. I think that's what's going to happen, but who knows?
And the discussion about why that's happening, that we can table that for another podcast.
Yes. So that's my take on volatility.
All right. And then Zach, you got anything to add to that about volatility or the other two pieces, being a saver, or you touch on interest rate expectations? That's kind of baked into the volatility mix, because some of the volatility is coming from that. Wouldn't you agree?
Yeah, a lot of it's coming from that. I'd say a majority, even some of it. You can see the way the market reacts to the moment Jay Powell starts talking at Jackson Hole.
Yeah. You and I were talking about that this morning. That's crazy to watch. And that was what was so wild to me, was that the equity market is sitting close to all-time highs and had such a strong positive reaction to his speech at Jackson Hole. And it's not like new data came into play. It was just him talking.
And he didn't say we're going to
do anything
in September. That's right. He didn't say that.
It was even positioned in the headline. The language even said something about like opening the door. And it's like, well, I think the door was already open. I think it wasn't ever shut. I don't
exactly
know what. Anyway, so sometimes it's the smallest little things, that the nuances that cause market reactions.
What do you guys think will happen if they don't cut rates in September?
The president will be mad. That'll be a big one.
Well, that's for sure. That's for sure.
Great answer, Zach.
But what do you think will happen to the equity market?
I would say my gut instinct is to say that it would be the reverse of what we're seeing today, right? So
Agreed.
Like if logic says that, markets, bond yields drop and the VIX dropped like a rock too. I think it was sitting around like 13 or something, and the equity markets rallied. And if that's the case for Jay Powell signaling some kind of, I guess what they would otherwise say is a dovish signal that the door is open for a rate cut, the next best thing to saying that they're going to do it, then logic would also dictate that the opposite would be true. So if the market thinks that there is a rate cut coming in September, which according to the FedWatch CME Group, the CME Group FedWatch tool, there is a 83% chance that is baked into markets right now as we speak that there is going to be a rate cut in September. So then therefore, if that rate cut doesn't come and the expectation is baked in already that it is coming, well then logic would say the reverse of today would happen initially based on that. But is that on the 17th of September when the Fed concludes their two-day meeting and we get the press conference again from Jay Powell when he speaks again about this at that point in time? I don't know. Does it come a week later or maybe later in the month in September because we get a really bad or good or upside or downside surprise PCE number, inflation number? I don't know, but that would be my guess. And the last piece of that I would say is one thing you and I were also talking about earlier today, Zach, is that the last 2 years in the stock market have been very strong, positive overall return years. And so that means we're working on a third year where we're already double digit. I think the S&P was up something like 10% or so year to date today, right now. So we're working on 3 really strong positive years in the stock market. And that kind of makes me hold my breath. How I know that the stock market is not the same thing as the US economy. And sometimes we could do a whole nother podcast episode just on explaining that, right? Because the stock market anticipates that, right? What's going to happen. But at the end of the day, that still kind of makes me a little bit more cautious than I otherwise would be, because we've had such back-to-back strong stock market years. And this year we've been very positive so far. So it's kind of like, well, that would fit the statistical narrative, I think, if we did see some kind of weakness in the back half of the year.
Can I throw something else at you?
Yes.
All right.
That was a long-winded answer, but that's
thank you. I appreciate that. I think our listeners need to hear, the full story. There's only 2 scenarios I think, that the Fed would cut interest rates. Would you agree? Prices, inflation, right?
Mm-hmm.
And the unemployment rate. Because that's the Fed's two mandates.
I was going
right?
to say, yes, that's why, right? It's
Right.
because they have a dual mandate.
They
So
have a
it's,
dual mandate.
they are supposed to react to those two things.
And
And
only
mainly, yeah, those two things.
Yes. Now, in order for the Fed to consider cutting rates, they would have to see either a drop, a sustained drop in inflation, or they would have to, you would expect them to then maybe cut rates if the unemployment rate jumped up real high, right?
Mm-hmm.
Right. That
Yeah.
makes sense. Yeah. I think that's something I would agree with too. So if the Feds cut interest rates because one of those two things happened, what does that mean for the economy and corporate profits as a whole?
Well-
So how can that be interpreted as a quote unquote positive signal, and kind of makes you scratch your head and say, well, if the Feds cut interest rates, that means they see a slowdown coming in some form or fashion. So how is that a positive signal for the market? Now you answered the question a little while ago, slightly, when you said the stock market, is a anticipatory mechanism for the future, right?
Right.
And so maybe that's the whole answer, that the market's not looking at today or tomorrow or next week. They're looking at 6 to 12 months down the road. But I would submit to you that if the Feds cut interest rates, that's not a good thing for the economy.
Touche. But you and I have said that over and over again. It's kind of like a knee-jerk, very human reaction, right? Because like we all know we're emotional creatures and all that kind of stuff, right? So it's like the initial thought is like, oh man, they're cutting rates. We're finally getting what we want. You know, okay, that optimism is just like, it's almost overwhelming and it just oozes into everything. And that kind of causes the markets to go up. People buy things, they get excited. But then after a few days pass, after a week passes, you start going, was that such a good thing? Because the knee-jerk reaction was overwhelmingly positive. But then when you really start thinking about it, you're like, yeah, they would, if they're cutting rates, what they're actually saying is things aren't that great economically, which means softer economic environment, which for the stock market means it's probably going to be a little bit tougher for companies to continue to churn out the profits that they have been churning out, which have been propping up their stock prices in the valuations in the stock market. So therefore, those valuations would have to adjust, and it wouldn't be in the up direction. It would be in the down direction if they are thinking that they're going to have a little bit tougher time cranking out profits at the same rate and speed and growth rate they were previously.
Now, if you're not a finance geek like we are, and you're listening to this, your head might have exploded about 5 minutes ago when we were talking about all this stuff. So
bring it home. Bring it home for us.
Yes. If you're an investor and you just heard my comments and Andrew's comments about the market and interest rates and what could happen if they raise them, lower them, keep them the same, you're not sure what to do. Zach, do me a favor and tell us, what should an investor do if they're listening to this and they're worried about some of the things we just talked about?
You should speak to a licensed advisor who has all their licensing and practice for a couple years at least, and maybe someone you trust if you can find one. If not, that's okay. You can come visit me, Andrew, or Gilbert. We're always open to educating anybody who's willing to learn.
What's our phone number?
Great plug.
Our phone number is 830-955-9900.
How about our website?
Our website is www.texashillcountryadvisors.com.
You got it. You got it.
That's awesome.
That's what
Thanks for the plug.
you as an investor should be doing. If you're listening to anything that we're talking about and you're not sure, how in the hell does this affect me? Or you're scared about it, or you're currently an investor and you're wondering about what your investments are currently doing and how come they're reacting to all this volatility, and you just want answers, you have questions, reach out. Reach out to either one of us three, reach out to your own financial advisor, talk to somebody, because the market and the economy changes, if you're an investor, you should probably think about how your portfolio is going to react one way or the other, good, bad, or indifferent. You don't necessarily have to know all the nitty-gritty details of how you're invested, but having a good idea of what your portfolio is currently doing and how it could react to changes in the market is probably not a bad thing. I would say this, it's kind of like your car. You don't have to know how to change your starter or your timing belt. Heck, you don't even have to know how to change your brakes, but you should know somebody that does, that can help you with those things when those things go south. And you shouldn't have a general idea, a rough general knowledge of how those things actually work. So that when the mechanic comes and says, "Hey, you need new brake pads," you don't necessarily say, "Well, what is that?" Pads. I didn't know we had brake pads. So it's like owning a car. You don't have to know all the nitty-gritty details, but it's probably a good idea to have a rough general knowledge of what it is.
Yeah.
And that's what we're saying about your investments. A rough general knowledge of how they work, where you're at, how your portfolio could respond. And me and Andrew and Zach would be happy to sit down with you and just review things with you. Give you our 2 cents worth. We're not going to charge anything. And of course, we're obviously hoping that you love us so much after that visit that you will let us manage your investments for you, either now or in the future. So if you're wondering about all those things and you've got some questions, we'd love to talk to you.
Great. Thank you for the great exit there. That was great.
That was a little bow on top.
That was awesome.
I like the way that worked.
Awesome. That was awesome.
That wasn't even intentional.
Well, and then to wrap it all up, the last thing I say is we didn't talk about being a saver that much, but when we talk about being an investor, sometimes that can be interchangeable with being a quote unquote saver. More of what we've talked about this year or over even the last year and a half since the Fed's really been raising interest rates is that because there's more meat on the bone now, if you will, with where interest rates are at, if you're just a saver in general, whether you consider yourself an investor or not, there's more options now than there have been over all the years past when interest rates were really, really low. So we'll continue to kind of expand on that topic as we move forward. So maybe next podcast we expand on that a little bit more, but it's still a good time to be a saver. There's still plenty of options out there, even though interest rates have kind of come down from their recent highs in the last year or so. There's still meat on the bone for even people on the conservative end of the investment spectrum.
Plenty of opportunities for sure.
That's it.
And next week we can talk about sophisticated option strategies.
Yeah.
I'm just kidding. We're not talking about options.
Okay, guys, that'll do it for us today. Thank you so much for tuning in. Don't forget, interact with us, share our content. We're on Facebook, LinkedIn, and YouTube. We'll catch you back here next time. Have a great week. Securities and investment advisory services offered through LPL, a registered investment advisor, member FINRA SIPC. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult with the appropriate qualified professional prior to making a decision.